Question number 26. This is an MTP RTP question, very important question, already has appeared also. So now let us check this. H Limited acquired equity shares of S Limited, which is a listed company, in 2 tranches. Step acquisition. On 1st November 2016, it acquired 15% stake, accounted as per 109 because it is not a associate. On 1st January 2017, it acquired 45%. So with this, they acquired a control. And they have purchased based on the quoted price in the stock market. Both the above mentioned companies are INR as a functional currency. Consequently, they controlled S on 1st of January 2007. So this is my acquisition date. Generally one odd date here, 1st January. Otherwise at the end of the year they would have given you. Now they have given you the balance sheet of only subsidiary, not the parent. So that means they may not be expecting a consolidated balance sheet here. Because if they ask you opening balance sheet, then they should give you a parent's balance sheet also. No, that means they must be asking some only workings probably. They gave you the balance sheet, carrying value and the fair value. By looking at this, we assume that this must be the carrying value and the fair value on the same day. But we don't know. Let us see. They have given me PP, intangible assets, financial investments, so many other things they have given you. Cash held for functional currency. 1 minute. Can you check what is the amount available there? Have I made it 4? 4, right? 4 and 4. Okay, I will tell you the background behind this. See, in the previous study material or RTP, MTP, they had given it 4.5. I always wondered, what is the fair value of the cash? You see, fair cash held in foreign currency, they give you fair value, different, understood. But the functional currency fair value only, how it will be changing? And no impact, no adjustment only. Simply they have given. In the new study material, is it a study material question? Test your knowledge somewhere, it must have there, no? Luckily, finally, they gave me a great relief by making it 4, 4. Chalo, good. I need not explain. It is a previous thing. I have to just tell you there is a background for it. So, no deferred tax is going to come into picture. Non-current assets held for sale. It is always shown net of cost. Fair value, net of cost to sell. In days 105, we are not yet discussed. Always we can show it cost, fair value minus cost to sell. So, they have got a equity share capital. Other equity, they said fair value not applicable. Equity share capital face value is 100. That means we have got some 12 lakh shares or something, into which price is going to give me 50.4. I don't know. We can always try that. 50.4 divided by 12 into 100. Into 100, when I multiply with the 100, I get 420. So this one price must be there for 420 share price. We don't know. Because they said fair value, no. How did you get the fair value? By multiplying number of shares into fair value. How many number of shares you have got? This is rupees in crores. 12 crores divided by 100 rupees face value, you get how much? 12 crores divided by 100, 12 lakhs into, that means 50.4 crores divided by 12 lakhs gives you 420 rupees. That means the market price must be 420. Now, financial liability borrowings, financial liability trade payables, so and so. PP in the above balance sheet includes the leasehold motor vehicle. Oh, that means the PP what they have shown you here is having some leased values worth 1 crore and the fair value of that is 1.2 crores. The date of inception of the lease was 1st April. On the inception of the lease, they have correctly classified them as a finance lease. That means I want to buy it. However, if the facts and circumstances were considered, this should have been classified as an operating lease. Now, did I strike it there in your... Okay, I will tell you one more background. In the new study material, this is removed. Sorry? Not there. That's what I am telling you. In the new study material, they have removed this information. But if I go to the suggested answer, they have given one note on that. See, the crux here is You have wrongly classified one operating lease as a finance lease. Now, Ind AS 103 permits you can continue with it. That's it. That's what one line you need to write. So, even though since they have removed it from the final syllabus, okay, like from the main question, so I don't give much importance to this. That's why I have also removed it. Okay, they have removed it, but example they have given there, like solution they have given on the note. Now, following is the statement of contingent liabilities. Lawsuit filed by the customer for 2 crores, its fair value is 0.5. It is not probable that you need to pay, but you have, and anything you will pay will be tax deductible. Not probable means, should you not recognize? Yes, we have to recognize because there is an exception. It says that even though it is not probable, you can recognize these liabilities. Now, what is the tax base of this? 0. Because only when you pay it, then it is tax deductible. Income tax demand for 7 crores, its fair value is 2 crores. It is also not probable. And what is the tax base of income tax demand? 2 only. Why? Arey Baba, on income tax only will you create deferred tax? It's a permanent adjustment, no. So, tax base and book value remains the same. In relation to the above mentioned contingent liability, S has got one indemnification undertaking to H Limited. Who is now S Limited? The owners of S Limited must have given one indemnification up to 1 crore in respect of above 2. So, will you recognize for 2.5? Yes, that's why full 1 crore you can represent. 1 crore represents the acquisition date fair value. So, indemnification asset also you can recognize. Any amount which would be received in respect of the above undertaking shall not be taxable. So, it is a permanent adjustment. So, your tax base is also same. So, no deferred tax is going to come on this. The tax base of the assets and liabilities of S is equal to their respective carrying values, whatever is there in the balance sheet. Oh, that means for me it's very easy. Wherever fair value adjustments are there, that is only subject to deferred tax now, because it's a tax base, it's its book value. They said what all items you see in the balance sheet, its tax base is equal to its book value. Nice, no. So now deferred tax application happens only for the fair value increases. Carrying value of non-current assets held for sale is 4 crore, represent the fair value less cost to sell. That means fair value is 4.5 minus 0.5 is the cost to sell. So the book value is 4. This one, this particular item. How did you get 4? 4.5 minus 0.5 is cost to sell. That's fine. That, which one? Cost to sell is selling expenses. And 105 says that you have to show net of cost to sell. In consideration of the additional stake purchased by H on 1st of January 2017, it issued to the selling shareholders 1 equity share of H for every 2 shares held in S. Now comes the purchase consideration. Equity shares of H Limited value is 10,000 rupees per share. So this is the purchase consideration issued in cash. Till now we were talking about fair value of net assets. See, you break this into pieces. Till now we were talking about the fair value of the net assets with the deferred tax impact, recognition of new asset which was not there, recognition of new liability which was not there, recognition of indemnification asset. All these are part of your fair value of net assets, no? Yes, imaginary line you put here. Now we will come to a different story. You are agreed to pay to the shareholders so much of shares. On 1st January 2017, H Limited paid 50 crores in cash also to the selling shareholders of S Limited. That means my purchase consideration is shares plus cash. Additionally, on 31st March 2019, H will pay 30 crores to the selling shareholders of S in return on, if the return on equity shares of S is more than 25%. What it is? Contingent consideration. H Limited estimated the fair value on 1st January to be 22 crores and 23 crores at the end of 31st March 2017, 23 crores. When the acquisition happened? On 1st January. When the books of accounts are going to get closed? 31st March. So the contingent consideration which you are supposed to pay after 2 years, whatever, if you achieve that profit, its fair value today is 22 crore. And in 3 months down the line, its fair value is estimated to be 23. Which one you will consider for business purchase consideration? 22. What is the difference? Measurement period adjustment? No, because this increase happened because time change, no. So this will go to P&L, additional consideration, whatever liability for you. Followed? Why? Because this has nothing to do with the measurement period. No, this is not a measurement that there was a mistake here. Instead of 22, it is 23. No, not like that. This was 22 on 1st January. This was 23 on 31st March. So in the 3 months period, there is an increase in the liability, which you will charge to P&L account only. Clear? Now the quoted price of the equity shares also they have told of S Limited when November 2016, when you purchased that 15% stake, its price was 350. 1st January 2017, it was 395. Now NCA, how much did you acquire? 100%? 60%. That means NCA valuation has to happen now. Have they told you which method of valuation? Okay. Now, as on 31st March, 420. Do you see this number anywhere? Somewhere you have come across, no? Now, if you go back and see this fair value, this fair valuation of 50.4, you understand this fair valuation is not on the date of acquisition, but this fair valuation is done on 31st March 2017, after 3 months from now. And you reasonably assume that this must have been fair valued 3 months back. But have they told you when the fair, following is the balance sheet as on that day, but have they told you when is the fair value? If that was the case, anybody will reasonably assume that it must be the fair value. Understood? Yeah, I understood. It sounds like it should be the 1st January, but if you see one item there, how come on 1st January the fair value of the equity can be 50.4? Tell me. 50.4. It should have been 395, no? Because on 1st of January 2017, what is the share price of S Limited? Okay, so multiply 12 into 395, how much you get? 47.40. But how come they said 50.4? Oh, is that mean that only one item they valued at the end of the year and rest every item they valued on 1st January? No. So you have to make an assumption that all these items they have valued on 31st January only, which is taken forward, except this which is on 31st December, 31st March. 31st March. Because this is of 420, no? Anyhow, see, to confuse you only, they have given no much implications. Don't worry about this. Yes, one more imaginary line you have to draw now. Because see, we are discussing about except for shares. We can take, see, that is our assumption here. The question is given in one confusing way. That's what I want to tell you. If somebody doesn't want to get confused, just leave it. Forget it, whatever they are trying to do. You don't, we can, it doesn't make any difference here. Followed, no? It's just a strategy to make you confused by giving one value of some other date. Now, one more imaginary line you have to put. On 31st May 2017, see, acquisition happened on 1st January, 31st March, you closed your books of accounts. On 31st May, H learned that certain customer relationship existed. Who is this? Brand. On 1st of January, which meets the criteria of intangible asset, but you didn't calculate. The fair value of such a relationship is 3.5 crore and assume there is no temporary difference associated with the relationship. There is no impact of income tax. They said, okay, good. Don't bother about the deferred tax here. Followed, no? Just ignore it. On 31st March 2017 itself, H further learned due to additional customer relationship that the fair value of this customer relationship has changed from 3.5 to 4. What you will do? Ignore. What about this? What should I do? Measurement period adjustment. Why? Because this information existed on the date of acquisition only, I didn't knew it. On 31st December, H established that he has obtained all the information. H and S are not related party and follow Ind AS financial statement. 30% is the deferred tax rate. This is the second part of the question. Okay, now let us discuss what they are expecting from us. You are required to provide detailed response to the following along with the reasoning. That means you have to explain with the computation notes. What should be the goodwill to be recognized by H Limited in the financial statement at the 31st March 2017? Not on 1st January they asked you. At 31st March 2017, what should be the goodwill? Huh? For this, you should calculate on 1st of January, no? Then one more measurement period adjustment is going to come. That's what you have to tell. What is the amount? We'll see, we'll solve this, don't worry. For this purpose, measure NCI using proportionate share of fair value. They said calculate the proportionate net asset method. Will the amount of NCI, goodwill, bargain purchase is going to be changed subsequent to 31st March 2017? Yes, because of the measurement period. See, first thing they asked you, what is your goodwill value on 31st? Whatever value on 1st January, that itself will be 31st March value, no? Is there any impairment? No. So, same value will remain. Second part of the question, is it going to change NCI and goodwill on 31st March because of that measurement period? Yes. Give journal entry. Not for the first one, that is for the second part of the question. That's what I told, this is part 2. How did I know? By looking at the solution. How will you know? I expect more clarity will be given in the examination question. I'll show you examination question also, how it will come based on this. No? By looking at it, you will understand this is the same examination question, but given in a different way. What should be the accounting treatment for the contingent consideration on 31st March 2017? There is an increase, no? From 22 it increased to 23, right? Contingent consideration. Customer relationship you will ignore. There is one element of contingent consideration, which is a 20-mark question. Huh? Contingent consideration, there is an increase, no? See, from January they gave you 2 things. On 1st of January there was like 50 crores paid in cash. Okay, so we will do step by step now. They asked us reasoning. So my I achieved so much that they have given. So my guess is 12 marks, 6 marks, 2 marks is my guesswork. Okay, let us write the solution quickly. A small way. One is lease classification. It will be same. Only impairment is going to affect. You would have calculated the fair value. And when the adjustment is going to come? On 1st of January, no? See, goodwill you calculate only once on the date of acquisition. Now, subsequently, up to 31st March, is there any changes to the goodwill? Only 2 things can bring the change, either impairment or measurement period. Impairment to not told, and the measurement period. Clear, no? Yeah, first write lease classification. As an exception, means one exemption given, H Limited can retain original lease classification. Actually, in reality, it is an operating lease. They have classified it as a retain, which lease? finance lease. Who? The subsidiary. But what I can do, I can take it as it is, whatever they have done. This is an exception given to me. I need not convert that into finance lease. Anyhow, today's day it is meaningless for me, because today's day it is replaced by an ROU asset. But why I am giving this? Because in the study material it is there. Second, NCA held for sale. As per Ind AS 105, NCA HS held for sale is measured at FV minus SCC, fair value minus cost to sell, selling cost. Thus, same will be fair value for business combination. Have you understood this? See, you have got one non-current asset held for sale. That means you don't use that asset anymore. Like one building, the machinery is there. You have kept it aside. You wanted to sell that. Like one vehicle is there. You are not using it. You have kept it for selling. Now, you H Limited went and acquired one subsidiary. That subsidiary has got one machine which they don't want to use for manufacturing. They have kept it aside for disposing it off. What is the fair value of that machine? 4.5 crores. What is the book value of the machine? 4. How did you get from 4 to 4.5? It is 4.5 minus cost to sell. Ind AS 105 says that whenever you keep any machine for sale, it should be recognized at fair value minus cost to sell. Like NRV, cost to sell, you have to minus and keep. Now, H Limited went and acquired. At what value will acquire? Standard says fair value. What is the fair value? 4.5. Will you ignore 0.5? That's what the standard is trying to tell. Look, when you acquire a subsidiary, that subsidiary may have any asset which is held for sale, which they will show in their books at fair value minus cost to sell. But when you take up, you don't take fair value. You should also take up at fair value minus cost to sell. That means, what is fair value for will? Fair value is equal to rupees 4 crore, not 4.5 crore. Otherwise, what happened? No, I would have told I will take it to 4.5. No, it's not 4.5. It is 4 only. Clear? So first, lease classification will explain that there is one exception, that I need not change the classification. I can continue, and I will non-current assets I will recognize like this. Third, contingent liability as an exception. Because they see why we are explaining, because they said reasoning as an exception in Ind AS 103, contingent liability can be recognized even though not probable, but can be measured reliably. That means, as per Ind AS 103 exception, you are going to recognize a contingent liability in your books, even though it is not probable, but you can measure it reliably. Therefore, CL is equal to 2.5 crore. And if you see all this explanation, you are talking about the fair value of the net assets. Next comes contingent, what is it called? Indemnification asset. So this expression is clear, no? As an exception in Ind AS 103, contingent liability is recognized even though it is not probable but can be measured reliably. So we are going to recognize contingent liability to the extent of 2.5, which is 0.5 case plus 2 income tax. Perfect. Now next write the heading indemnification asset. Indemnification asset is recognized at its fair value of rupees 1 crore as it is less than contingent liability of rupees 2.5 crore. Further, there is no deferred tax effect. You understood, no? So, indemnification asset, what we are going to do? We are going to recognize that its fair value of 1 crore only. Why we are recognizing full? Because the liability is more than that. If my liability was 70 lakhs, I would have ended up recognizing only up to 70 lakhs. Am I going to recognize deferred tax on this? No. Why? Because they said it is not tax deductible. Now I have got the next item, previously held equity, 15%. It is remeasured at its fair value, gain or loss transfer to P&L. This already we discussed today morning. The moment you have got step acquisition, you have to use that word called a remeasurement, and the gain or loss should be transferred to the P&L. Yes, that's it. A fine note you may have to give if the same question comes. If another question comes, I will show you based on this, they may change the question. Okay, what should I do next? First you tell me. What is the question? What is the question? Calculation of the goodwill. So should I write calculation and with reasoning? Reasoning I have given all adjustments, whatever I am supposed to do, I told. What should I do? Purchase consideration, is it a big thing? Okay, I could have done that. Can I start with the fair value of the net assets? Yes. Anyhow, if you want, you can start with the purchase consideration also. Okay, why? Yeah, we'll start with the fair value of the net assets. 1. Calculation of fair value of net assets. It doesn't matter, anything you can start with. See, this time I will not go for that net asset basis because you will end up with so many confusions there. Or can we do that net asset? Yeah, because there are so many adjustments. So I will take this method where this is the deferred tax adjust, temporary difference, tax base, fair value. I'll draw 4 columns. Even in suggested answer also they have done that way on. PPE. What is my fair value? $90. What is my tax base? 40, because they said book value itself is the tax base. So temporary difference is 50. So what I'm going to get? Deferred tax liability 15 at the rate of 30%. So like this, one by one item I'll go. Intangible assets 30, 20. So we have got 3 deferred tax liability. Investment 100, 250, 75. Or alternatively, you could have done that net asset basis also. We will do it one by one. Inventory 20, 20, no deferred tax. Next. Yes, Vishnupriya, what is next? How much? This is also 2020. Cash 44. NCA we will take 44. Followed, no? We will take it as 44. Cash is also 4. NCA is, see, this was the problem for me because previously they had written 4.5. Now in the new syllabus, no problem, 4.4. NC also 4.4, and I have explained the note. We will not take 4.5. Clear now, Vidya? Is there any more item of asset? I have got an indemnification asset, no? How much? 1. What's the tax base? It's a permanent difference, no? 1. Because the indemnification, they said they will not give you any deduction for this. It's not taxable. See, with this working, when you add up this, you get the fair value of the net assets. Means liability. Now we will start with the liability. Plus this deferred tax we will adjust, no? Then we got a single deferred tax, like full. Next I will proceed with the borrowings. Same I will add, continue, borrowing. How much is my borrowing? 20, negative value, please be careful. No deferred tax. Trade payable 28. Warranties 3. Current tax liability 4. Okay, now tell me what is next. I have got a contingent liability. How much? Will I write 2.5? Or will I split it into 2? I have to split into 2. Why? Because on one deferred tax is going to come and on the other deferred tax is not going to come. Because other thing I have to pay to income tax department only, no? So on this I am not going to get the deferred tax. Yes, Vidya, clear, no? You have any doubts, Vidya? Which one? Yeah. Indemnification is 1, provision is 2.5. So my accounting entry will be indemnification asset account debit to 1, goodwill 1.5, to contingent liability 2.5. Perfect? Okay. Next, what else I have got? Contingent liability. How much? Fair value 0.5 for a lawsuit. What is tax base? 0. Deferred tax? Asset or liability? Asset. Now I have got one more contingent liability, income tax, in bracket IT. How much? 2. Tax base? 2. No deferred tax. So if I add, am I done with all the items? Tell me if there are any more items for fair value of the net assets. And see, we are done now. Tell me, is there any item which is pending for accounting? Previous, sir? Equity is not fair value of net assets. No, equity plus reserve is nothing but the book value. Another way, okay, let us try that also. Since you please try academically. So what you do, other way, take the net book value, add all the fair value adjustments with the deferred tax. Because see, now it becomes, that's why I am following this format. Because if I tell you deferred tax adjustment, so many items are there here. So what is my total fair value of the net assets? When I add this total, it comes to 461.50. My deferred tax liability will come to 92.85, the last column, when I add net. These are all my fair value. If I add this total, I get 461.5. This is my fair value of net assets. Now, if I, on this, there are certain adjustments where deferred tax is appearing, and if I take the total, I will get 92.85. Since this is the liability, I am going to reduce it from my net assets. And I will get 368.65, and big amount of marks will be allotted to this. Because other things are fairly simple, not a big deal there. If you see the notes, explanations, everything revolves around this particular thing. Up to here, be careful. No, goodwill also you should be careful, but here you cannot compromise, you cannot miss anything. Are you clear? Yes. Next, what I will do, and why did we do the fair value of net assets first? NCA valuation is based on not fair value, no. NCA is proportionate. See, previously we used to leave some space, straight away do at the bottom. Can we do this working at the bottom? That's why first thing I will do this, and then I'll calculate the purchase consideration. Second, purchase consideration. What is cash? How much cash did you pay? ₹50 crore. Is there anything did you pay? Did you pay anything else? Anything else you paid? Shares. You tell me, I will write. You dictate me. How much shares did you issue? ₹12 lakh shares into 45% stake you took. You took 45%, no? Into 1:2, half, into per share 10,000. Are Baba, whose shares you are issuing? You are issuing the H Limited shares, no? Have we not done this previous two questions? Same story, no? Don't multiply 60% because 15% was already acquired previously. 15% is already acquired. 45% now you acquire. 12 lakh is the total number of shares, or 12 crores divided by 100 face value gives you 12 lakh number of shares. Clear, no, Prithvi? Dhanashri? So how much? 270 crores. Is there anything else? Vishnu Priya? Is there anything else? You didn't get this? See, now, who issued shares to whom? H Limited issued to S Limited. Now, they said that for every one share, 2 shares of S, H will issue its 1 share, 1:2 ratio. So, how many shares they have, S Limited? 12 crore face total nominal capital divided by face value 100. You get 12 lakh shares. You acquired 45% of it. Into half, into per share 10,000 rupees, of whom H, not S, sir, don't consider now, because you are issuing your shares, no. So you get 270 crores. Is there anything else? Contingent consideration, how much? How much? $22. You have know that on 1st of January you have agreed to pay if the profits are going to increase. That's a contingent consideration. See, if you see by now, it's the plug and play only, no. We are not discussing any new concepts, small concepts only. Is there anything else you paid? Cash you have paid, shares you have issued, contingent consideration, then you had a previous held equity. So you can add it here only. Previous equity. How much? 7 points. So how much was the total number of shares? 12 lakhs. You already hold 15% of it, no? Previous held equity. Of 12 lakh, 15% you hold. Into, what is my share price? 395 on the date of acquisition, no. And whose share price? S Limited share price. Because this is my previously held equity in the subsidiary. It is a step acquisition, no. Alternatively, this you could have shifted to the next line. You could have said only these three things are your purchase consideration, but study material they have added this also as a purchase consideration. When 2016, huh? It was purchased from 2014, no? But when the acquisition, when you took the control, 2017, 1st January, should you not remeasure it? This price is of 1st of January 2017, a remeasurement date. Nice question, no? And then purchase consideration. This is purchase consideration. See, now here you may argue with me, sir, why you have added previous equity here? You could have added in the next line, no, as a part of purchase consideration plus. Okay, you should have added here. So it doesn't matter. Generally, see what I have seen, they will treat this also as a purchase consideration. They say that this is also purchase because I am foregoing, no. Till yesterday, it was my investment. Today I am going to foregoing my investment. You remember when it was an associate, did we de-recognize that associate? That means literally I am foregoing. No, that's what they are telling you, that your previously held equity for getting 100% net asset, this also you have given, foregone. So they will treat it as a part of the purchase consideration. Are you clear now? So you have. Sorry? Now see, you have got 45% here, 50% here, total 60%. Plus 40% is made up of that NCI. What I am trying to tell, in all the question, purchase consideration we added up to here only. This was a part of that goodwill calculation. Purchase consideration plus previous equity plus NCI. So in this particular question, I have added it here only. So if you say no sir, it's confusing, okay, you can leave it and add it in the next. But yeah, instead of 349, you will tell me 50 plus 270 plus 22. You will say this is purchase consideration. How much? 342. So you will say 342 here. Then fair value of previously held equity 7.19. You would have told me like that. So this is one question where they have treated it like this. That's what I am treating. You are finding it confusing, you can show it here. It is just a risk of 1 mark. Because if they say no, that is a purchase consideration, gone, we cannot argue. Sometimes, since it's the big number question, I'm just showing you the way they have done it. At least I should tell you. Otherwise, tomorrow when you refer the study material, you will ask me the same question. So fair value of the net assets. So yes, I got a goodwill on 1/1/2017. And if we see, this is the major working, this is the very small working, this is okay, reasonable working. This working has got 2 components, one previously held equity plus cash consideration, contingent consideration and your equity share consideration. And now you are very clear which numbers, where we have taken, why we have taken, why we multiplied some consideration with 10,000 rupees, why we have taken for 395 rupees. Okay. Yes, now we will come to the question what they asked. A, calculation of goodwill on 31/3/2017. So opening balance of goodwill. How much is your opening balance? 127.92, because you would have passed one journal entry on 1st of January with the goodwill entry. Now, is there any changes after this with retrospective effect? Yes, what is that? Customer relationship. So customer relationship Is it going to increase the goodwill or decrease the goodwill? How much? Or 60% of 3.5? Yes, Vidya. Customer relationship is there, one item. So it is going to decrease my goodwill. Correct? Why? Because if I knew on day one, I would have debited customer relationship. In this net assets, no. Have you included that customer relationship in 368.65? No. If you would have included, I would have, this net asset would have been more. Goodwill would have been less. You didn't do it. So today I have to deduct it. But when I deduct, will I deduct 3.5 or 60% of 3.5? What about this NCI? How did you value? You remember the two journal entries I showed you? Because if this was included on day one, your NCI would have been more, no? Your net assets would have been more and NCI would have been more. So you will deduct retrospective customer relationship 3.5 into 60%, 2.10. So you are going to show goodwill balance 125.82. See how many concepts are sitting, and every single concept connected with the journal entry. Everything journal entry, you see, and it is very easy also. I just should go for by the flow. I should know what that concept is all about, how journal entry will be posted. And this is what we do in real life also. Ultimately, every accountant does these entries only, no? Done? Yes. Second part of the question, measurement adjustment. We'll write one small theory. Any adjustment, I'll write a short theory, okay? I'll share you any adjustment during measurement period to be done to goodwill retrospectively. After that, it is done as per Ind AS 8. In the given case, customer relationship existed on 1st of January 2017, so accounted retrospective. Okay, I have written a small theory for you. The theory goes like this: any adjustments, so goodwill may change, goodwill may increase, decrease. Anything during the measurement period will be done retrospectively. After that, any changes happening, it will be done as per Ind AS 8. In the given case, the customer relationship existed on 1st of January, which the acquirer was not aware. So that's why that will be accounted retrospectively by adjusting to the goodwill. Okay, so in theory, when you practice, you have to write this. 1 or 3 business combination says if initial days, if we are not able to complete, you can finalize based on the provisional amount. During the measurement, you can also recognize assets and liabilities if it's the new information obtained about the facts existed on that date, but it should not exceed 1 year from the date of acquisition. Any changes will be retrospective. In the given case, there is a customer relationship which is within 31st December 2017. Therefore, it will be treated as an intangible assets and it will be retrospectively adjusted for the goodwill. So, what is your accounting entry? Can you tell me the journal entry? Which one? Sorry? Which account debit? Brand or customer relationship. Brand account debit. How much? 3.5. Straightforward. 2. Goodwill how much? 2.10 to NCI 1.40. Why? Because you followed a partial goodwill method. Any increase after measurement period is not accounted as it is internally generated brand. So your journal entry will be brand account debit to goodwill, because they asked, how do you account it and what is the journal entry. Brand account debit, goodwill account debit to NCI. Any increase happening after measurement period will not be accounted as it is considered as an internally generated goodwill. So much theory is also there. Any increase, because again from 3.5 it became something 4, no, you ignore it. Okay, and the last question, last part of the thing, treatment of the contingent consideration. It is classified as what? Financial liability. Any changes will be accounted in P and L. So accounting entry will be fair value loss debit, because you can't classify this at amortized cost because it is the fair value, no. Have you calculated this contingent consideration by discounting the future cash flows? No, that's why it is not your, it is the financial liability, but you cannot amortize it. That's why if you go to the basis of calculation, if you have got your notes or something, in days 109, basis of calculation, there are 3 bases of calculations. One is amortized cost by default. Any financial liability by default, it's a amortized cost. Then there is FVTPL. In FVTPL, they said that business contingent consideration in business combination. Not that. Specific basis of measurement, the third one. You remember that specific basis of guarantees. We have done the guarantee accounting, no? Guarantee is a financial liability. And then the second thing is a contingent consideration in business combination. There was no sum. No, guarantees there was one sum that parent gave to, but contingent consideration no sum. Here this is what we are talking about. Because contingent consideration cannot be shown at amortized cost. Meaningless, no. Did we discount it to show at amortized cost? That's why we show at FVTPL. So fair value loss account debit to contingent consideration. So my accounting entry will be this. Maybe 1 mark or 2 marks. So primarily you are going to tell that a contingent consideration, since you are paying in cash, it is a financial liability and you are going to account it at FVTPL. You cannot calculate, show it at the amortized cost because you didn't discount the future cash flows. And your 109 also talks about the same thing. That's a nice question, no? And this question came in your examination. It's called swan and duck, but in a little different way. Okay, next in May 23, this question has come.